Okay. Let me just say what you're going to say again. In this seminar, Eric Wexler will discuss identifying financial and tax issues during mediation and collaborative team meetings and the primary benefits of engaging a financial neutral in contested and collaborative cases. Anshu Karki will outline the key benefits which parties derive from the team approach utilized in the practice of collaborative law and ways to benefit from a financial neutral or expert even outside of the collaborative context. Any questions that you have for our speakers today, please type them into the chat box and we will address them at the end in the order received. Eric J. Wexler has been practicing law, tax, and accounting since 2002. His law office is located on Monroe Street in Rockville. Eric graduated from the University of Maryland with a bachelor's degree in accounting, and he graduated from the George Washington University Law School, where he served on the ADR board. Eric is licensed to practice law in Maryland, DC, and New York. He is a past co-chair of our collaborative law section and former president of Collaborative Dispute Resolution Professionals. Eric is a member of the Maryland Association of CPAs, as well as the American Institute of Certified Public Accountants. He has gained extensive insight as to tax and estate planning, tax reporting, IRS procedure, and federal and state audits over the course of his career. Fun fact about Eric, during the pandemic, he ran at least 10 miles per week in the streets of Rockville, which I told him is about 9 miles more than I walked each week. The first portion of this seminar will focus on the team approach, which is used in collaborative law practice. In 2014, Maryland passed the Uniform Collaborative Law Act under Courts and Judicial Proceedings, Title III, Subtitle 20. The collaborative practice model can be utilized in any civil case, including but not limited to divorce and custody matters, estates and trusts, business disputes, and business dissolution matters. But a collaborative mindset is useful in any context. The collaborative practice model enables parties to a dispute to utilize the expertise and input of trained collaborative professionals of their choosing during the dispute resolution process. It fosters candid and effective out-of-court communications, which are directed toward voluntary, durable, and win-win options, as well as solutions. Collaborative practice is interdisciplinary and may at each client's choosing incorporate not only collaborative attorneys, but also collaborative coaches who are licensed mental health professionals, child specialists, and financial neutrals into the process. Members of a collaborative team are interdependent, and their efforts are directed toward the goal of resolving the outstanding issues between the parties through information gathering, open and effective communication, and a written settlement agreement between the parties. Our first speaker, Anshu Karki, is a collaboratively trained family law attorney who practices in Maryland and DC. She also practices family and business immigration law, representing clients all over the US and abroad. She's a graduate of Towson University and University of Maryland's Francis King Carey School of Law. Along with being a co-chair of our ADR and collaborative law section, she's also a section council member of the ADR section and of the immigration law section of the Maryland State Bar Association. Anshu has been practicing collaborative law her entire legal career since taking the course in law school, and she has used the skills and tools of collaborative practice to help her clients amicably restructure their families, both within and outside of collaborative cases. She is officially opening the doors to her own firm, the Law Office of Anshu Karki, on October 1st, 2020. Fun facts about Anshu: she's originally from Nepal, which is a beautiful country in Asia. She came to the US at the age of 19 for college with a plan to return home, but then she pursued a career in law and decided to stay. So with that introduction, I give you Anshu Karki. Thank you, Anshu.
Thanks, Laura. Hi, everyone. I'm Anshu, and we're going to jump right in. So I want to start off by just piggybacking off of what Laura said about collaborative practice. So I just want to give a brief overview or a recap for those of us that may not be familiar. So collaborative law is a voluntary, out-of-court, alternative dispute resolution process where parties sign a written agreement to do what makes sense for all parties involved. A great thing about collaborative practice is that we use other professionals, other experts like mental health professionals, financial professionals, or even people with expertise in other areas like realtors, mortgage brokers, appraisers. And the reason for doing this is that clients benefit from the expertise of not only the attorneys, but all these other professionals to make the best decision for themselves and their families. So today we're specifically going to focus on one piece of the collaborative law case, which is using financial professionals or financial neutrals. And we're gonna talk about how you can use this piece of collaborative in a collaborative case, but also in cases outside of collaborative. So in other ADR processes and as well as in litigation. So what are the different ways that you can use a financial neutral outside of the collaborative law process? So some of the ways, you can bring them in negotiations, you can bring them in mediations, you can have them review specific provisions of a separation agreement that you either have already drafted for your client before you finalize it or while you're negotiating. So as attorneys, and especially as family law attorneys, we end up wearing multiple hats sometimes. We become therapists, we become financial advisors, and we end up inadvertently giving advice about all these areas that we're not specifically trained in, and then we load them up with a bunch of disclaimers that I'm not a financial specialist, I'm not a mental health professional, blah, blah, blah. So is there a better way to do this? So there is. You could simply just bring in someone that has the expertise in that area, like a financial professional, a tax professional, to actually give that advice to the clients. And just because you're not in the collaborative law process doesn't mean that you cannot do that. So it's a great way to take that liability off of your shoulders, but then also have that expertise from the other person. As I said, this can be done in any other process, especially in family law cases, if you're negotiating or you're in a mediation or you're simply drafting a separation agreement. So what are the common financial and tax issues that when you see, you may want to think about whether you want to bring in a financial expert to help you? So some of the most common issues, especially in family law cases, are income-related issues, figuring out what someone's income is and what you're going to use in resolving your case. There's tax-related stuff, those dependency exemptions and other exemptions related to children that often come into play. And then there's the great ever-changing tax code and changes in tax law that we constantly have to keep up with. So apart from the liability issue and having an actual expert talk about these issues to the clients and help clients understand these issues, clients also benefit from hearing it from the horse's mouth. I often find it much more effective at getting clients to see what the actual numbers are and getting them to respond better when they're hearing it from me, as well as someone who is actually a financial expert. So I find that really helpful. And it's always beneficial to have like multiple perspectives from the client's point of view as well. And the other like psychological piece of this is like when you have this other neutral also telling the clients, these are the numbers and this is what the tax code is, and you see that the clients are still hesitating, then you know that the issue is not just the numbers or the actual financial issue. There is an underlying reason that you need to work with the client on. So it's also helpful in that sense. So just as what we're talking about today, I'm going to actually practice what I preach. And as we get into the nuts and bolts of tax code and all of the fun stuff, I'm going to turn it over to the expert, Eric Wexler.
Thank you. Thank you very much, Anshu. I appreciate it. And I just want to reiterate, that in my experience, oftentimes clients and occasionally attorneys will be putting forth a position. And when you dig down, they'll say it's these numbers or those numbers, but when you dig down, it's really not the numbers. It's some other issue, whether it's something surrounding the children or some of the underlying reasons for the termination of the marriage and other things that people sometimes disguise as a number. And one of the more common numbers that people are familiar with but like to dispute is income. And what is income? And I'll just throw a few examples of income. And I know this might sound a little bit basic to a few folks, but bear with me. We'll get to some detail in a minute, but I did want to lay the foundation. The first bullet point, wages, salary, retirement, those are the most familiar types of income. People know, how much money do you make? They know generally how much money they make if they're being paid a wage or a salary. They know I make X per year or X per hour. Retirement is even a familiar number to most people. They know, well, when I retire from the federal government, I'm going to be getting X as a monthly retirement amount. Or Social Security, I'm going to be getting X as my benefit amount. Or I've saved up this much for retirement. I'm not 100% sure what that means on a monthly basis, but I know I have this much in my IRA or in my 401k. So that's generally a known. The next bullet point, business profit, that's one where, anything goes. And some of the disconnect is unintentional and some of the disconnect is intentional. So when I look at my business profit, anything that's there as a profit, in my opinion, is a statement of failure. I shouldn't have any profit this year. I should have spent it all on business expenses. Of course, that's not true. But when I take my child's preschool tuition and say, oh no, that's a business expense, I'm chipping away at my business profit. Now that's not allowed. You're not supposed to take personal expenses like my child's preschool tuition and count it as a business expense. But you would be surprised at how many people do that. And they do that in order to lower their taxes. It's clear, if I don't make any money, I don't need to pay taxes. But then and that's between you and the Internal Revenue Service. But when you are dealing with a third party, now they're going to look a little closer. Then, the IRS might not audit you this year and you can get away with writing off your child's tuition. Please know that I'm not saying to do that. That is incorrect and is wrong. But as a practical matter, if you do it and they don't audit you, you'll get away with it. If a third party is looking at your business profit, you're not going to get away with it. They're going to say, wait a minute, that's not a business expense. That's you bought jewelry for some other person, or the kid's tuition, or your sports car, or whatever you're spending money on. That's not a business expense. So when we talk about business profit, we have to keep in mind that there is the tax return business profit, but then there's also the real business profit. And that's an important distinction. Sometimes it's not much of a distinction at all, but in other situations, it's a huge distinction.
And can I just jump in here? So like in this situation that Eric's talking about, so you can see like that you might have a client who's saying, oh, I've been doing my taxes this way for 10 years and taking all these deductions and I've never like gotten into trouble, or this is what the IRS has accepted as my income. So I'm not going to budge from that. So in that situation, then you say, okay, here's the tax lawyer you need to talk, or tax professional you need to talk to, and then, bring them back to gently bring them back to doing what they're supposed to do.
Exactly. Thank you, Anshu. That's excellent. And gently is a relative term. Some folks are more gentle than others. But absolutely, clients do get, especially business owners, because business owners have a certain, and I'm a business owner, so I can say this. We have a certain personality that's not always flexible, and especially when it comes to my business and my profit and my numbers, I know what's best, and that's the mentality that flows through. So to Anshu's point, you have to gently move them to the right answer. Moving on to rental property profit, it's the same discussion. It's usually less egregious here simply because people are not as emotionally invested in their rental properties as they are in their actual active businesses. Investment income, interest, dividends, capital gains. I'm sure everyone here is familiar with those concepts. Again, we don't have to spend a lot of time on that. Just know that that is income and does count. This is a bit of an old slide because I'm going to show you there's one more type of income that's missing from this. And 3 years ago, this next bullet point would have been true, but it is not as true as it once was. We'll get to in detail later, but spoiler alert, alimony for new divorces is not taxable to the recipient. It's treated the same way that child support has always been treated, which is it's a non-issue on the tax return. The payer no longer gets a deduction, and the recipient no longer has to report that as income. Now, if you had a divorce from 1990 and you're still getting alimony, you're still going to have to pay tax on that, and the payer of the alimony is still going to get a deduction. And if you had a divorce in 2017, then the same thing happens. It's only the new divorces, and we'll get to that in a moment. But alimony, which used to be an income item, you'll see that not so much moving forward. Let's see. So speaking of the tax return, I wanted to review the 1040 form, and we can just do line by line, I think, for everybody. We'll start with lines. I'm just kidding. We're not doing that. That was my attempt at humor. Boy, everyone must be muted. I don't hear much laughing. So the types of income that we spoke about, I want to give everybody the simple tools that they'll need to be able to identify what types of income they will be looking at. So if we want to look at the bottom left, with alimony, that doesn't have a form to go to the human person that's getting that income. As opposed to your investments, when those investments go to a human being, they do so via a form 1099, which again, I think most people are familiar with. Sometimes it's called a 1099-DIV or a 1099-INT. Those are just the different types of investment income, but that 1099 form generally is for investments. The next is employment and consulting. And I've lumped these two together because a lot of people lump them together, not necessarily correctly. If you're an employee, you get a form called a W-2. And if you're an independent contractor or a consultant, you get a form 1099. It's a different 1099 than the investment 1099, but it's a 1099 nonetheless. The reason these are lumped together for this slide is that oftentimes you will have somebody who is truly an employee and should be getting a W-2, but in fact they're getting a 1099. And there are reasons beyond the scope of this presentation that that's done. It's not correctly done, but as a practical matter, I see it all the time. But those are the forms you'll want to keep an eye out for with regard to, in connection with employment and consulting. Estates and trusts will file a 1041, and the 1041 will generate a Form K-1 that goes to the human person that's receiving that income. So if I had a family member that passed away and they had an estate that had taxable income, and that estate had to file a 1041, but I'm inheriting everything, it's really my stuff, I'll get a K-1. And again, you're probably familiar with what a K-1 is, but it's something that when you see it, that should send up your radar to say, all right, do I understand what this K-1 says? Do I understand what it means? And if I don't, it's time to consult a financial professional. Partnerships also give you a K-1. We don't have to drill down on that too much. Corporations don't give you a K-1. They'll send either a W-2 or a 1099 to the human person. So I own a company, and I don't know if you've heard of it. They make phones, and they have an apple on the outside of it. And it's Apple. And I own a very, very, very small amount of it. Now, I don't work there, so I don't get a W-2. But if they pay dividends, I do get a 1099 from them. And that's as opposed to an S corporation, which I would generally own if I'm working in the business. And that will give me both a W-2 and a K-1. So the slide here is not something to memorize or be tested on. It's simply just maybe a place to look so that you know, hey, I just saw K-1. What was that again? And you, oh, it's either an estate or a partnership or maybe an S corporation. It's one of those three. Or, oh, I got a 1099. What is that for? And then you can look at the slide and go from there.
And I've in fact, just looking at this, if in any case, I mean, W-2s, 1099s, I'm okay. Anything other than those, I always make sure that I bring someone in that has more expertise in that area to help me understand whatever the documents are that I'm looking at and what I'm dealing with. And I mean, as you do this more and more, of course, we end up acquiring a lot of the knowledge and are able to issue spot, but it's not just enough to issue spot. We need to understand these documents in detail. And that's when I would bring in someone like Eric to help me figure it out.
Yes, and I'll add to that, Anshu, that by the time you have enough familiarity that you can competently issue spot, rest assured, they will change the tax.
Change, right.
And that brings me to my next slide. The Tax Cuts and Jobs Act of 2017. So this was the big tax law change of a few years ago that I'm sure everyone here might remember. A lot's happened since, so it might be buried in your memory, but it was a big deal at the time. The first year that it would take effect would be 2018. And it did a lot, and it did a lot of very drastic and different things. And, you know, we can debate whether it's good or bad, but it doesn't really matter. It is law. So the first component that I'd like to talk about is to what extent it is temporary. It's supposed to sunset in 2023. As most of us might guess, Congress does not like to take away things that it has given to us. So if it gave us some goodies in this piece of legislation, it's going to be tough for them to say, we're going to take it back.
Right.
And again, we can debate the merits of that. We can debate the morality of that. I'm sure we're all in agreement here, but it's besides the point. It is good law until 2023. If Congress acts before then there'll be a new tax law starting then, or it'll be a continuation of the existing law, or it'll revert back to the old system, which Everyone will have had 5 years to forget, so we'll have to relearn it at that point. So that's the first point. The second point, and I know this is not the biggest feature of it, but it's one of the more popular things to talk about. It's more fun to take a $75 meal expense than it is to take a $30,000 qualified business income deduction. It's just, you know, even though the $30,000 deduction does way more good for you than the $75 deduction does. Meals and entertainment, which is the second bullet point of the slide, has always been a favorite of people because it's fun to go out and take someone to lunch. Obviously, with everything going on with COVID, that's a much different picture than it was for the years prior. But at some point, we'll be back to having business lunches, and this will become an issue again. The 2 bullet points underneath it, I think sums it up. Business meals are okay as long as they're not lavish. You can take someone out, but it can't be lavish, and lavish is in the eye of the beholder, and it also is in the context of who I'm taking out, and what they're going to be paying me, what the expectation is. If I am a sports agent signing, you know, $100 million sports contracts, it's going to be a different standard than if it's Eric Wexler, you know, doing tax returns in Rockville. It's just, those are 2 different meals. And the second bullet point is employer provided meals. And that's, my staff is working on a Saturday for tax season. I buy them, you know, lunch because they're in the office. I used to be able to deduct all of it. Now I can only deduct half of that. The other 2 items I wanted to talk about with respect to the Tax Cuts and Jobs Act of 17 is alimony, which I spoke about before. If you have your agreement in place before December 31st of 18, you're under the old system. The old system being alimony is deductible and it is taxable for the recipient. If your agreement is January 1st of 19 or more recent, then alimony is treated just like child support in that it doesn't factor in as a deduction and it doesn't factor in on the recipient's end as includable income. The last point on Tax Cuts and Jobs Act of 17 is dependent tax credit. This has always been, in my mind, one of those items that's more of an emotional issue than a dollars and cents issue. 2 people are getting a divorce and they have a child. Who gets to claim the child on the tax return? What most people hear is, who does the child love more? And that's who gets the deduction. And so they fight tooth and nail for this deduction. The truth of the matter is it's not worth a whole lot of money, and it should be treated accordingly. But again, you have to make sure we're separating the emotional component from the actual numbers. It used to be a approximate $4,000 deduction, which would mean different things depending on your tax bracket. If you were in a 50% tax bracket, if there was one, then a $4,000 deduction would be $2,000 of cash in your pocket. If you were in the 10% tax bracket, then a $4,000 deduction would equal $400 of cash in your pocket. After the Tax Cuts and Jobs Act, they changed it to just giving cash. So if you have 17 years old or younger, I'm sorry, if 16 years old or younger, if they're under 17, it's $2,000. If they're older than 16, then it's $500. And that's it. And it phases out when the income is about approximately $500,000, depending on your filing status. But under that, it's $2,000 cash for 16-year-olds and younger, and $500 for everybody else. Another piece of legislation that I think was missed by a lot of people, because it took effect about 5 minutes before COVID became a way of life. And I mean that a little bit kiddingly. It was in January of 2020. We talked about this again for a few minutes, and then everybody got distracted, appropriately so, with COVID. The Secure Act has to do, well, there's really three things to take away from that. The first is required minimum distributions. That is, RMDs, required minimum distributions, is a requirement that if I have saved up $1 million in my IRA, at some point, I've got to start drawing down from it. Now, I can draw down from it today at the age of 45, and I'll pay tax on it, and I'll pay a penalty. But I don't want to do that, so I'll wait until I'm older. But let's say I just want to keep waiting. At some point, I have to start pulling out some of it. And that is the required minimum distribution. It used to be at 70 and a half, now it's 72. And then after COVID started, they said, well, you don't have to even do it for 2020, but we'll get to that in a minute. The second bullet point is the kiddie tax. All you have to know about that is if we have children, minor children, who have investments, you know, I don't want to pay taxes on all the shares of Apple that I have, so I'll just put them in my kid's name and I'll get around it. That doesn't work because the kids have to pay this kiddie tax. They made some changes to it with the new tax law from 17. The Secure Act just put it back to the old system. And finally, this actually would give you some creative new options in a collaborative case. The 529s that people have saved for that have to be used for college, we can also now use it for apprenticeships. We can use it to repay student loans, which is a huge deal. Of course, it's a $10,000 lifetime limit, so it might not make a dent, but a little bit's better than nothing. And then you can use it for K through 12, $10,000 per year per student. So now I'll catch everybody back up to COVID. March 16th is the day I'll always remember as the day my office went into complete disarray. It was boxes and computer wires everywhere and people scrambling to take their stuff home. With half of the people saying, why are we doing this? It's only going to be 2 weeks. And the other half of the people on March 16th said, no, 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 this could be as long as 2 months. So clearly everybody was wrong. But they did pass some legislation shortly after that in an effort to provide some relief to people. Now, people are familiar with the $1,200 checks that went out. People are familiar, especially the business owners, with the PPP, whatever that stands for, I don't know, but it was free money for business owners. It was the Paycheck Protection Program. People are familiar with that. And then, of course, the SBA EIDL loan. But these are all business goodies, and human beings don't really take advantage of any of that except the $1,200. And if you make, you know, more than what I call Montgomery County middle income, you're not going to get that $1,200 bucks. It's about 100,000 depending on your filing status, is what you would be phased out of getting that $1,200. So what did the tax relief do for humans? The first bullet point here is you can take 100,000 out of your IRA penalty free. So I alluded before that if I want to take money out of my $1 million IRA, I don't have a $1 million IRA. If I did, and I wanted to take money out of it, I'm 45 years old, I have to pay tax on it just like I received it as income. But I also have to pay a penalty, whether it's 10% or 12.5% or 25%, depending on the type of IRA. And that penalty is on top of the regular old income tax. So it can be more than half. The tax relief said, if you want to take out money from your IRA this year in 2020, because you have a hardship and you need the money, you can do it. You can do up to 100,000. After that, then we think you're spending too much. But you can pull $100,000 out of your IRA, and yeah, you have to pay taxes on it, but we're going to waive the penalty forever. And the taxes will even let you spread it out over the next 3 years. So if you need the full 100, take the full 100 and worry about the taxes later. The caveat is that the states generally are going to make you pay income tax. Some states have done some things for relief, and I suspect early next year we'll see other states catching up as well, because there's going to be people angry that said, I pulled $100,000 out, I didn't think I'd have taxes, and now the state is telling me I have taxes. And the other piece is that RMDs, the amount that I have to take out if I'm over 72, are suspended for 2020. If you want to leave it in, so it's like the opposite of the $100,000 withdrawal. If you don't need the money and you want to let it ride in the stock market or however you have it invested, you can do that. You don't have to take out required minimum distributions for 2020. And if you already did, you can put them back. So that is...
And that goes for beneficiary IRAs as well.
That goes with inherited IRAs that are using the 5-year rule, where there would be required minimum distributions as well. That is true. Okay, I know I want to switch it to Anshu, but I didn't know, Laura or Anshu, if there was anything that needed to be addressed before moving on.
It doesn't look like we have any questions. So I just want to remind everyone, if you have questions, you can type it into the chat box, and we'll make sure to answer it before we conclude or as we're talking. So we're nearing the end of the presentation, and we wanted to end it by giving you some examples of how I have used a financial expert in my cases that are non-collaborative. So these are some of the issues that when I saw, I brought someone in and found it really helpful to resolve the case, or help me get a better understanding, even in litigation, of how best to argue. So some of those situations have been when calculating like what the actual value of someone's pension or retirement is. Oftentimes, especially with people with pensions, one spouse will say, I want to waive any interest I have in the other person's pension or survivor benefits, that kind of stuff. So then to help you analyze what's the actual dollar amount, what's the actual benefit that someone's given up, or they'll say that I will give this up, but I will take X amount of the equity in the house. So to help you do an apples to apples comparison, you can bring in a financial expert to give you, run those valuations for you and give you the actual numbers, give you some numbers to work with. And I'm talking about these examples, and I would love to hear if any of you have used any of these, have had any of these experiences and brought in a financial person. Like, feel free to let us know in the chat, because I think it's helpful for all of us to know these situations, so that we can refer back to it and be like, oh, this is somewhere where I or clients could benefit from bringing in a financial expert. So the other example was when both parties were on board. They wanted to pay for college for their children. They wanted to know, out of all of their assets, what was the best way to figure it out. So I brought in a financial person to run the numbers, do the cash flow forecasts. Another common example is, again, running cash flow scenarios with the different settlement options that the parties may be pursuing. Preparing budgets, another common one. Financial experts are really good at doing that. They often have programs that really streamline the process and make it a lot easier, save everybody time and money. And the clients definitely like that. And and sharing your numbers and your financial expert's opinion with the other side. So I've had cases where the attorney on the other side and I have actually agreed to use one financial person, and that person shares the information with both sides. So it's a collaborative piece, but we're using it in a non-collaborative way. So you can always do that. And if the other side is not on board, you can always have the financial person come in and do that on just for you. And you can always share those spreadsheets and that information with the other attorney. And that can help you guys bridge any gaps you might have. And then, tying it back to what I said earlier, once clients and the attorney on the other side have all the numbers, it can help move the conversation forward in a way that with just the attorneys talking, it might not have been possible. So these are some of the scenarios, and would love to hear if anyone else uses financial professions in any other creative ways, and then we're happy to answer any questions. I know there's a question, a tax question, so I'll read it.
So there's a question from Nancy. She would like to know, how has the tax consequences of alimony changed the alimony discussion in settlement agreements?
Anshu, you want me to take that?
Sure.
And I want to hear Anshu. This is my guess as a financial neutral, and then I want to see if I'm right. And Anshu, you can tell me. I think it is simply adjusted the amount. So if everything pointed to a $3,000 a month alimony payment under the old system, and remember, under the old system, the recipient wouldn't get $3,000 because the recipient would have to pay tax on that money, and the payer of the $3,000 wouldn't quite be paying $3,000 because he or she would be allowed to deduct that and get a tax benefit. So if the old system said $3,000, they would look at the tax rate and do an estimate and say, okay, let's just call it $2,000 under the new system, where the recipient is getting $2,000 because there's no tax consequence of receiving that, and the payer is truly paying $2,000 because he or she is not enjoying the tax deduction. Anshu, did you have a similar experience?
So I mean, it does make it a little harder to convince the payer, as I'm sure a lot of family law attorneys can relate, because that was one of our things, right? Oh, but you get this tax deduction. So now, I mean, that piece is not there, but I mean, I haven't necessarily seen it hasn't gotten much difficult, except for I have that one piece that I used to regularly use is no longer there, so.
Good, thanks. There was a second question that I want to touch on regarding 529s. And just to be clear, the way a 529 is titled is with one human being as the owner of the 529, and another human being, or the same human being the beneficiary of the 529. So I have a 529. My name is Eric Wexler, and I am the owner of the 529. And my daughter, Samantha, is the beneficiary of the 529. Now, if we decided that, Samantha, she's 10, if we decided, she might not be college material, but her sister, she'll be all right. We can change the beneficiary from Samantha to her sister, Jessica. Or if Samantha is so smart that we know she's going to get a scholarship and she won't need that 529, again, we can change the beneficiary to her sister, Jessica. Or if both of them get scholarships or don't go to college, then we can change the beneficiary to whoever we want. So I just wanted to put that out as the foundation. And the question being, so I'm just finding it.
How does the owner deal with it in a will? So do they transfer by beneficiary designations? Like, can you designate alternate beneficiaries, and then can you designate alternate owners? or do you have to have provisions for it in a will in the estate planning context?
That's a good question.
Right.
I don't think I have an answer offhand.
Yeah, I don't remember. Yeah, I've never had that situation either.
Well, the other thing is, can you hear me?
Yes.
The other thing is I could picture this as people become more familiar with them, and it's a good tax benefit, particularly for state income tax, because you get a deduction of up to $2,500 a year for each beneficiary. So, but I can visualize this as becoming an issue between relatively well-heeled clients who say, okay, we have these 529s and altogether they're worth like 150,000 and you own them all. And you can take the money back if you decide to do that and spend the money on yourself. You just have to pay a tax and a penalty for that. So I don't know the answer to the question either, because I have the 529s and I know that there's no, at least in the T. Rowe Price ones in Maryland, there's no provision for an alternate owner or, and so like if I died tomorrow and I owned these 529s, okay, so what? How do they get handled? Are they, I mean, I don't know. I intended to look at T. Rowe Price and talk to their people, but I've never gotten around to it. But I can visualize it as an issue in a divorce context too.
Yeah, it's a good issue. I actually am in a case now where there is a substantial, I don't know, I mean, 300,000 or 400,000 in the 520, and it's a few 529s that are titled, all of them entitled in the name of one of the two spouses.
Mm-hmm.
The nice thing about ADR and collaborative, well, any ADR really, is that you can do what you want. And they are in process of coming to an agreement because they're not going to spend all that money on college and other educational expenses for their children. They're just not. So they're going to have leftover 529. And the question is, well, what do we do with that? And they're in the process of coming to an agreement. And some of that money they're just going to take back and pay the penalty and pay the tax and say we have better use for it and we're fine with the penalty. And other portions of the money, they're finding creative ways, and one creative way, especially during these times, to have the 529 balance go to the parents is, let's say my daughter is in college and we still have a pandemic. And she's going to live at home. Well, so the 529 can be used for room and board. So I can pay myself from the 529 up to, and I think it's like a 14,000 a year or maybe a semester. I mean, some pretty good sum to house and feed your college student child.
You can buy computers. I think you can buy equipment too, like computers and different things too.
Yeah, you can do certain things, but a lot of times they say, well, how are we going to get the money? I mean, they already have enough computers. They already have we want that money back to spend on a boat or whatever. And one creative way to do it penalty and tax-free is the way I just said. But you're right. They can simply take it back and pay the tax in the penalty.
Or they could split them up by changing ownership. I mean, they could, transfer the ownership so they had equal amounts, and then they'd be able to equally decide how they wanted to spend their money.
Yeah.
But I mean, from a tax perspective, they're a real boon. I mean, if you have enough money on a yearly basis to commit to them.
It's not, just remember, a $2,500 tax deduction in the state of Maryland is going to get you less than $250 of cash in your pocket, because Maryland's charging 8 or 9% income tax, with depending on the county. So yeah, I get a $2,500 off per program per child.
If you have 10 of them like I do, it makes a big difference.
I'm sorry.
If you have 10
I
of
thought you
them.
said you had 10 children.
No, I have grandchildren, so
Oh.
I have 10 of them.
Wow. So then that is a nice deduction. Yes,
Mhm.
I agree. Good. Anshu, do we have more questions out there?
No.
So we're getting close to 1 p.m. So I'd just like to ask Robin and Ashley if you could join with audio or video and let us know if you had any questions or not.
I do not have any questions at this time, but the presentation has been great. Thank you.
Okay, thank you.
I do not have any questions either.
Okay, thank you.
You can look at the comic and see if you think it's funny. Not so much.